Between January 12th and January 19th, 2026, precisely 33.45 million ounces of silver vanished from COMEX registered vaults in 7 trading days, a withdrawal rate that erased 26% of the exchange's deliverable inventory in a single week and left clearinghouses scrambling to explain what market participants already understood in private. The paper-to-physical ratio that underpins the modern silver market had quietly reached its breaking point, and the institutions that spent 15 years building short positions in the expectation that futures contracts would settle in cash, not metal, were now facing a forced participation event they could neither defer nor hedge away. This is not a drill, and it is not a retail-driven squeeze that exchanges can contain with circuit breakers and volatility pauses. This is structural failure playing out in real time across the London bullion market, the Shanghai Futures Exchange, and every major clearing vault from Brinks to Deutsche Bank, where the assumptions that governed silver pricing since the 2008 financial crisis are being tested by an opponent that does not negotiate. Physical scarcity in an environment where counterparties have decided, en masse, that contract settlement in fiat equivalents is no longer acceptable. The CME Group responded to the December rally, which saw silver climb from $28.92 at the start of 2025 to over $84 by late December, with 3 margin hikes in less than 3 weeks, the last of which landed on December 30th when most traders were off-grid for the New Year holiday, raising initial margin requirements from $20,000 per contract to $32,500, a punitive 62.5% increase that forced undercapitalized longs to liquidate positions and triggered a 17% price correction that should have restored order to a market the exchange described as experiencing extreme volatility. It did not restore order. It revealed the opposite because within 48 hours of markets reopening in January, delivery notices for the March 2026 contract began piling up at a rate that vault operators had never encountered outside of crisis. And the first CME delivery report of the new year confirmed what insiders had been whispering since mid-December. JP Morgan Chase, the institution that spent a decade accumulating an estimated 750 million ounces of physical silver in private vaults while simultaneously holding short positions on COMEX to suppress spot prices, had reversed its strategy entirely and was now standing for maximum physical delivery, pulling metal directly from Deutsche Bank's registered inventory and forcing Citigroup and other clearing members to follow suit or risk being caught on the wrong side of a market where the exit doors were narrowing by the hour. The implications of this pivot cannot be overstated. When the largest vault operator and market maker in the silver complex shifts from selling paper contracts to demanding physical settlement, it sends an unambiguous signal to every other participant. The institutional consensus that silver futures were a purely financial instrument, a tradable abstraction divorced from the logistical realities of warehouse receipts and shipping manifests, has collapsed. And the clearinghouses that guaranteed contract performance on the assumption that fewer than 2% of longs would ever demand delivery are now staring at a March 2026 delivery month where open interest remains elevated, registered inventory sits at 33 million ounces and falling, and the ratio of paper claims to physical ounces available for delivery has compressed to a level that makes further margin hikes not just inevitable, but existentially necessary for exchange survival. On January 14, 2026, the CME implemented its most aggressive margin reform in the history of silver futures, shifting from fixed dollar requirements to a percentage of notional value model that automatically scales collateral demands as prices rise. Initial margin is now pegged at 9.9% of contract value, which means that for every $10 increase in the spot price, traders must post an additional $4,950 in collateral per contract, a structure that functions as a de facto price ceiling because it makes leveraged long positions prohibitively expensive above $100 per ounce and forces commodity trading advisors, hedge funds, and algorithmic traders to either exit positions or lock up capital that could otherwise be deployed in equities, bonds, or currency markets where margin requirements remain stable and predictable. But here is what the CME rule change does not address, and what every clearing member is now calculating in private risk meetings. If physical demand continues at the current withdrawal rate, COMEX registered silver inventory will hit zero in less than 3 weeks. And when that threshold is crossed, the exchange will face a binary choice between declaring force majeure and admission that it cannot fulfill delivery obligations on contracts it sold, and triggering a cash settlement protocol that would instantly destroy confidence in every other commodity futures market under CME oversight, or allowing spot prices to rise without limit until physical holders are willing to sell, a scenario that would expose the true extent of synthetic supply in the silver market and force central banks, sovereign wealth funds, and institutional allocators to reprice an asset class they have systematically undervalued for 2 decades. The quiet rule changes are already underway, though they are being implemented without press releases or public comment periods. Bloomberg reported on January 9th that the Bloomberg Commodity Index slashed its silver weighting from 9.6% to 3.9%, a draconian reduction that goes into effect immediately and forces index tracking funds to sell silver futures and reallocate capital to other commodities, a move that conveniently provides selling pressure at the exact moment when clearinghouses need it most, but does nothing to address the underlying problem. There are more claims on silver than there are ounces in vaults that can be delivered within the settlement windows specified in COMEX contracts. On January 23, 2026, silver broke above $100 per ounce for the first time in history, driven not by speculative excess or retail mania, but by arbitrage flows between London and New York, where premiums for immediate physical delivery have decoupled from futures prices by margins wide enough to justify the cost of air freight, insurance, and vault storage, and where Chinese buyers are paying $8 per ounce premiums over spot to secure metal that cannot be sourced domestically after Beijing's December 2025 export restrictions shut down the flow of refined silver from Yunnan and Inner Mongolia smelters to international markets. The United States Mint suspended production of Silver Eagles on January 14th, citing supply chain constraints in language that carefully avoids admitting what Mint officials know to be true. The blanks they purchase from private refineries are no longer available in sufficient quantities to meet even baseline retail demand, because those refineries are diverting output to industrial buyers in the solar, semiconductor, and defense sectors, who are willing to pay premiums that the Mint's fixed pricing structure cannot match. This is the environment in which banks are now freezing silver buying programs, not because they have lost interest in the asset, but because the margin calls they received in late December and early January have forced Treasury departments to reassess their exposure to a market where price discovery has broken down, where the spread between paper and physical has widened to levels that make hedging impossible, and where the institutions that wrote the rulebook are now rewriting it in real time to prevent a cascade that would make the 2010 London whale incident look like a footnote in financial history. But what comes next is not a return to equilibrium. It is a test of whether the clearinghouse system can survive contact with a market where physical holders have stopped selling and paper shorts have no path to exit without triggering the very squeeze they spent a decade trying to suppress. The mechanism that trapped the banks is deceptively simple, which is precisely why it remained invisible to most market observers until the moment it activated. COMEX silver futures operate on a fractional reserve model, where the exchange guarantees contract performance not by holding physical metal in a one-to-one ratio against open interest, but by maintaining what it calls registered inventory, ounces that have been pre-certified for delivery and sit in approved vaults under warehouse receipts that can theoretically be transferred to contract holders who stand for delivery instead of rolling positions forward or closing them out for cash. The word theoretically is doing enormous work in that sentence because for decades the system functioned on an unspoken assumption shared by every clearing member, every market maker, and every regulator at the CFTC that fewer than 2% of long position holders would ever demand physical settlement, which meant that registered inventory could remain at levels far below the notional tonnage represented by open interest without creating operational risk, as long as the price remained stable enough to discourage arbitrage between paper and physical markets, and as long as the major banks that anchored the short side of the trade, JP Morgan, HSBC, Citigroup, Deutsche Bank, maintained sufficient vault capacity to absorb the small percentage of delivery requests that did materialize during contract expiration months. That assumption held through the 2020 silver squeeze attempt, through the 2021 Wall Street bets-driven rally, and through every prior episode of retail enthusiasm, because in each case the exchange could deploy margin hikes as a circuit breaker, raising collateral requirements to the point where leveraged longs were forced to liquidate, which in turn generated selling pressure that brought prices back down to levels where industrial buyers could step away and wait for better entry points. But in late 2025, something fundamental shifted in the structure of demand. Instead of speculative longs driving the rally, the bid was coming from entities that do not trade on margin, do not respond to volatility, and cannot be shaken out by exchange rule changes. Sovereign buyers accumulating strategic reserves, industrial conglomerates securing multi-year supply contracts ahead of anticipated shortages in solar panel production and military electronics, and most critically, Chinese state banks acting on behalf of the People's Bank of China, which quietly reversed a 2-decade policy of silver disposal and began treating the metal as a monetary asset equivalent to gold in the context of de-dollarization strategy and commodity-backed trade settlement frameworks under the Belt and Road Initiative. When JP Morgan's vault operations flipped from issuing warehouse receipts to demanding physical withdrawal in the first week of January 2026, It signaled that the bank's risk models had identified a scenario where remaining short, or even neutral, carried greater downside than the reputational and capital costs of reversing a 15-year positioning strategy in full view of the market. If COMEX registered inventory falls below the threshold required to satisfy delivery demands for the March contract, and if the exchange responds by imposing cash settlement, JP Morgan would face lawsuits from counterparties who entered long positions with the explicit contractual right to take delivery, and those lawsuits would expose the extent to which the bank had sold claims against physical ounces it did not possess and could not source at prevailing prices. The legal term for this is failure to deliver. And while it carries different consequences in equity markets versus commodity markets, the precedent it would set in a COMEX default scenario is catastrophic for any institution that operates as a clearing member across multiple exchanges, because it would call into question the enforceability of futures contracts in general and invite regulatory scrutiny from the CFTC, the Federal Reserve, and international bodies like the Bank for International Settlements that have spent the last decade trying to contain counterparty risk in over-the-counter derivatives markets. This is why the margin hikes are not working as intended. They are raising the cost of holding long positions, but they are not addressing the underlying imbalance between physical supply and contractual claims. And in fact, they are accelerating the problem by forcing traders to choose between posting additional collateral or standing for delivery, which means that every margin increase the CME implements to cool speculative demand has the paradoxical effect of increasing delivery notices from participants who decide that taking physical possession is cheaper than continuing to roll contracts forward in a market where backwardation, the condition where near-term futures trade at a premium to deferred contracts, has emerged for the first time since 2011, signaling that immediate supply is more valuable than future supply and that the market is pricing in the possibility that ounces available today may not be available 3 months from now. The cascade works like this. As registered inventory drains, the ratio of open interest to deliverable ounces compresses, which forces clearing members to reassess their exposure and either source additional physical metal to cover short positions or buy back contracts at escalating prices in a market where liquidity is evaporating because long holders are not selling. The banks that wrote silver shorts as a hedge against mining company forward sales, or as a component of structured products sold to retail investors, or as part of volatility arbitrage strategies that assumed mean reversion, are now discovering that their hedges are unhedgeable. There is no offsetting position they can take that neutralizes the risk of being forced to deliver ounces they do not have, because the physical market has decoupled from the futures market in a way that makes traditional risk management frameworks obsolete. When Deutsche Bank's vault inventory dropped by 12 million ounces in the first 2 weeks of January, it was not because the bank decided to sell, it was because JP Morgan and Citi presented delivery demands backed by COMEX warehouse receipts, and Deutsche Bank had no legal option except to transfer the metal, which in turn left its own clients, hedge funds, commodity trading advisors, private wealth accounts, scrambling to source replacement ounces from a physical market where premiums over spot have blown out to $8-12 depending on jurisdiction and form factor. This is forced participation in its purest expression. Institutions that designed their operations around the assumption that silver was a paper instrument are now being compelled to engage with the physical supply chain, and they are learning in real time that warehouse capacity, refining bottlenecks, transportation logistics, and vault insurance are not variables that can be solved with leverage or algorithmic trading, which raises a question that no clearing member wants to answer publicly, but every risk committee is now modeling in scenario analysis. What happens to the banks that cannot source the metal? They are contractually obligated to deliver when the March 2026 expiration arrives. And how does the system contain the contagion if even one major institution declares force majeure? For households watching this unfold from outside the institutional machinery, the translation is straightforward but uncomfortable. The silver market is not experiencing a temporary squeeze that will resolve when speculators take profits or when mine supply catches up with demand. It is undergoing a structural repricing event where the paper claims that have suppressed spot prices for 2 decades are being retired through forced delivery, and the institutions that benefited from that suppression are now either hoarding physical metal in anticipation of scarcity or quietly exiting exposure entirely because their risk models can no longer quantify downside in a market where the clearing mechanism itself is in question. What this means for the individual saver or retiree who holds silver as part of a diversified portfolio is that the asset you purchased as insurance against currency debasement and financial system fragility is now performing exactly the function it was supposed to perform, but 6 months or a year ahead of the timeline that most conservative analysts were forecasting, and the decisions you make in the next 30 days will determine whether you capture the upside of this dislocation or whether you get caught in the liquidity vacuum that forms when physical holders stop selling and dealers stop posting two-way prices because they cannot source inventory at levels that allow them to honor bid-ask spreads. The signals you should be watching are not the ones that appear in mainstream financial media. CNBC will not tell you that registered COMEX inventory is now at levels last seen in 2015. And Bloomberg terminal screens do not flash warnings when vault withdrawal rates exceed historical norms, but they are visible if you know where to look. Monitor the CME's daily delivery reports, which are published every afternoon and show exactly how many contracts are standing for delivery versus rolling forward. And if you see delivery notices continuing to climb while registered inventory falls below 25 million ounces, understand that you are witnessing the final stage of a liquidity crisis where the exchange is running out of ounces to deliver. And clearinghouses are preparing for outcomes that include cash settlement, trading halts, or position limits that would effectively freeze the market and trap participants on the wrong side of a regulatory intervention designed to protect the exchange rather than the contract holders. Watch the premium spread between physical dealers and spot prices. If you see American Silver Eagles or Canadian Maples trading at $15 to $20 over spot, when historical premiums run $3, $5, that is not dealer gouging. That is price discovery happening in the retail market because the wholesale market has stopped functioning, and it tells you that the ounces available for immediate delivery are worth significantly more than the futures price suggests, which means that either futures prices will rise to meet physical, or physical will decouple entirely and trade in a parallel market where COMEX pricing becomes irrelevant to actual transaction clearing. The threshold that matters most is Monday, February 24th, 2026. That is the first notice day for March contract delivery, and it is the date when longs must declare their intention to stand for delivery or roll positions into May. And if delivery notices exceed 6,000 contracts, which represents 30 million ounces against a registered inventory that will likely be below 30 million by that date, the exchange will face a mathematical impossibility where promises exceed available ounces, and the rule changes that follow will be written in emergency session without input from market participants who are not clearing members. The smart preparation is not to panic buy at 100 per ounce spot or to sell into strength hoping for a pullback that may never materialize. It is to verify that the silver you own is in your physical possession or in allocated storage where you hold legal title and can demand delivery without being subject to pooled accounts or unallocated claims that leave you as a creditor in the event of dealer insolvency, because if a major bullion bank or retail dealer cannot source the metal they owe to clients, you do not want to be waiting in line behind institutional counterparties who have legal teams and priority claims in bankruptcy proceedings. For those who do not yet hold silver and are evaluating whether to enter at current prices, the calculus has shifted from "is silver overvalued relative to gold" to "can I source physical ounces at any price if this situation deteriorates further?" And the honest answer from dealers in the last 72 hours has been increasingly evasive. Lead times that were 2 weeks in December are now 4 to 6 weeks, and several major wholesalers have suspended price quotes entirely, which means they are not confident they can fulfill orders even if customers are willing to pay prevailing premiums. And that breakdown in dealer confidence is a leading indicator that the physical market is seizing up in the same way that mortgage-backed securities markets seized in September 2008 when no one could agree on pricing because no one trusted the underlying collateral. What remains unresolved, and what no central bank or regulatory body has addressed in public statements, is whether the Federal Reserve or the U.S. Treasury will intervene to stabilize the silver market if COMEX faces a delivery default, and whether such intervention would take the form of emergency lending to clearing members, a strategic release from government stockpiles that have not been inventoried publicly since the 1990s, or a regulatory mandate that forces cash settlement and retroactively alters the terms of existing contracts in the name of systemic stability. Each of those options carries consequences that ripple far beyond silver because they would establish precedent for how commodity markets are treated during supply crises, and they would signal to every other market participant in copper and platinum and palladium and crude oil that futures contracts are not binding commitments but contingent promises that can be rewritten when the institutions that sold them cannot perform. The weekend ahead is not a time for complacency. It is a time to verify your positions, confirm your storage arrangements, and understand that the financial system is discovering in real time that there are limits to what can be solved with liquidity injections and margin adjustments. Because silver is not a derivative or a synthetic instrument, it is a physical element with finite above-ground supply. And when the claims against that supply exceed the ounces that exist in deliverable form, someone will not get paid. And the question that determines who wins and who loses in that scenario is devastatingly simple. Do you hold the metal, or do you hold a promise?